Money, money, money. Will the stock market ever stop dropping? I have watched the stock market continue to slide for the entire year. In this video, we'll look at the captivating history of the stock market and see what we can learn about the future by looking at the past. Our story begins in Belgium with the Bourse. A bourse is the closest thing we have to the modern stock market. It was first recorded in 1493 when men would get together and trade commodities and bonds at a local inn in Burgess. In the 1500s, European ships started to sail to the Americas, and ship owners would raise money by selling stock in the ship. The investors would then split the profits upon its return. This, however, was fraught with risk, and many ships did not return, leaving the investors with severe losses. So investors would diversify their risk across many ships. Next, we move to Amsterdam in the Netherlands, where in 1602, the first publicly traded joint stock company hit the market with the Dutch East India Company, or VOC. This allowed investors to invest in all of the ships in the company at once, reducing their losses. The Dutch East India Company soon started to pay a dividend, which caused the stock to sell for even more money. Soon, other East India companies began to copy this model in numerous countries. The wildly successful East India stocks continued to gain value by returning profits to shareholders, until finally, a company called the South Sea Company in Britain failed to pay a dividend, resulting in one of the first stock market crashes in history. The United States exchanges. Now, we will move across the ocean to the Americas. The first United States stock exchange was the Philadelphia Stock Exchange, PHLX, founded in 1790. However, it was soon surpassed by the New York Stock Exchange, which was founded in the Buttonwood Agreement by 24 stockbrokers in 1792. The New York Stock Exchange remains the largest stock exchange in the world. The NASDAQ, the second biggest stock exchange in America, wasn't founded until 1971, when it became the first electronic trading system as the new kid on the block. If you find this information useful, go ahead and hit the like and subscribe button so that we can get this information out to more people who need it. For the next half of the lesson, we'll take a look at some of the most well-known stock market crashes in U.S. history. Finally, we'll look at some lessons we can learn from the past. First up, the panic of 1907 resulted in the New York Stock Exchange falling by almost 50% and risked falling further until a banker by the name of J.P. Morgan pledged large amounts of his own money to shore up the U.S. banking system. He was soon able to convince other bankers to do the same thing, calming the U.S. markets. The numerous problems exposed by the panic of 1907 soon led to the foundation of a national banking system, now known as the Federal Reserve Bank in 1913. Next up is the big daddy of them all, the Great Depression of 1929. It started with Black Thursday, an 11% drop just minutes into the trading day. It was soon followed by Black Monday and Black Tuesday, with an additional loss of 23% in just 2 days. The market continued to fall 89% over the next 3 years. Additionally, it took around 25 years to regain its highs, making it the longest drop in U.S. history. Black Monday in 1987 resulted in a massive 22.6% drop in a single day, which was the largest loss in a single day in the stock market history. It continued to drop 36% and took 2 years to recover to new highs. 2007-2009 financial crisis. While the recession started in 2007, it wasn't until 2008, when Lehman Brothers collapsed, that the real panic set in. The market dropped 54% over 2 years. It recovered to new highs 6 years later in 2013, and it was later called the Great Recession. The COVID drop in 2020. After COVID-19 became a worldwide pandemic, the market dropped quickly, by as much as 34% in just 1 month. We regained previous highs in just 6 months following the drop. The 2022 drop. The market peaked in January and has continued to drop the entire year, with the Dow only dropping 22%. But the S&P 500 and Nasdaq, respectively, dropping as much as 27 and 37%. This one's relatively new, so we don't quite have a special name for this one yet, but we'll see how it ends up by the end of the year. So, what can we learn from these market crashes? First, let's look at a bear market. A bear market is when the market drops 20% or more from its high. The average length of a bear market is 9.6 months or 288 days, and there have been 26 bear markets since 1928, with an average drop of 35.6%. Lesson 1. The stock market can drop massively in a very short time. How can this help us? We can institute dollar cost averaging, where we slowly buy our positions over a longer period of time. Lesson 2. Because of these large and quick drops, we can keep 10 to 30% of our portfolio in cash, so that we have the resources to take advantage of these drops. Lesson 3. Only risk what you can afford to lose. We don't want to put our life savings into a market that can drop 22% in one day. We need to diversify across many different assets. Lesson 4. Most crashes had very strong growth prior to the crash. So in good markets, we want to be disciplined and build up our cash reserves and take profits on any position we do not see ourselves holding long term. Lesson 5, the most important lesson of all, is every one of these crashes has recovered and hit new all-time highs. So don't panic and sell long-term positions unless the fundamentals of the business have changed. Wow, we learned a lot today. Dragon Financial is a new channel on YouTube, so help us out by liking and subscribing so that we can grow and get this information out to those who need it. Also, it is so important to have a basic understanding of finance before we continue our series on the stock market. So, if you need a refresher on any of these topics, click on the playlist so that you can review it now. Join us next time as we find out what is a stock.